Maya is standing in the parking lot of a hardware store, holding 4 paint swatches she picked up on impulse. Sage Whisper, Oat Milk, Concrete Gray, Actual Concrete. She doesn't own a wall to put any of them on. Not yet. Her card gets declined for the $34.20 charge, not because she's broke, but because she forgot to transfer money out of savings. She laughs, transfers it, pays, and drives home to the 2-bedroom she rents with her twin sister Elena. They are 29. Identical twins, right down to the eyebrow scar from a childhood bike accident. Same college degree, same starting salary of $72,500, same $65,000 sitting in savings after 6 years of splitting rent and cooking at home instead of ordering out. Genetically indistinguishable. Financially, about to become a case study. That night, Maya tells Elena she's done renting. She wants a door she can paint whatever color she wants without a landlord's permission. Elena, holding the exact same bank balance, says she'd rather keep her money loose. She doesn't know if she'll still be in this city in 3 years, and she likes not having to know. 2 women. Same numbers. 2 decisions. Let's follow both of them for 20 years, in real detail. Every payment, every repair, every rent hike, every dollar invested. And see what the paint swatches actually cost. If you're currently deciding between the 2 yourself, drop your city and your current rent in the comments. I'll tell you what I'd run the numbers on. And if you want the full spreadsheet version of everything in this video, it's linked below. Maya finds a 2-bedroom townhouse for $410,000. She puts down $65,000, just under 16%, which means she also gets stuck paying private mortgage insurance until her equity crosses 20%. Closing costs land at $11,200. Appraisal fees, title insurance, lender origination fees. A home inspection that turns up a hairline crack in the foundation that the inspector assures her is cosmetic, probably. Between the down payment and the fees, her entire savings account is gone before she's hung the single picture. Her loan, $345,000 at 6.75% over 30 years. Principal and interest alone comes to $2,000 a month. Add $310 in property tax, $140 in insurance, and $95 in PMI, and Maya's true monthly housing cost is $2,783. Elena, meanwhile, signs a lease on a comparable townhouse 4 blocks away for $2,150 a month. No PMI, no property tax bill, no line item for the roof. She takes the $65,000 she didn't spend on a down payment and puts it into a low-cost index fund. The $633 monthly gap between what Maya pays and what Elena pays also goes into that same fund, automatically, on the 1st of every month, before either of them can talk themselves out of it. In Maya's first mortgage statement, $1,940 of her payment is interest. Only $298 actually reduces what she owes. Out of $2,783 total, less than 11% builds anything. The rest disappears the way steam disappears off a shower door. You know it was there, but you can't point to it afterward. Their cousin Dana sells real estate on the side and flips a condo that same year. Buys low, paints it herself, sells it 4 months later for a $38,000 profit. She posts about it. She buys a boat. At Thanksgiving, she gently suggests that renting is paying someone else's mortgage, which is the kind of sentence that sounds true until you actually do the math on it. Nobody argues with her. It isn't worth it. 18 months in, Maya gets her first property reassessment. The county decides her home is worth more than it was when she bought it, which is good news for her equity and bad news for her tax bill. Property tax climbs from $310 to $344 a month. She also discovers, the hard way, that homeowners insurance in her state just went up 12% region-wide after a bad hail season 2 counties over. Her total monthly cost creeps to $2,860. Elena's rent, on schedule, rises to about $2,281. The gap between them has narrowed slightly, but Elena's automatic contribution stays roughly the same because she built the transfer around her rent, not around whatever's left over. By this point, Maya's home, appreciating around 3.5% a year, is worth close to $439,000. Her mortgage balance has fallen only to about $337,000. Amortization is slow at the start. The bank collects its interest first and gives up principal reluctantly. Her equity, roughly $102,000. Elena's portfolio, meanwhile, sits around $95,000. The two of them are, once again, uncomfortably close. Chapter 4, Year 4. The Furnace. 4 years in, Elena's rent has crept to about $2,420. Meanwhile, Maya's furnace dies in February during the one cold snap the city gets all year. Replacement, $6,100. She'd budgeted for exactly this, roughly 1% of the home's value annually into a maintenance fund, so it stings, but it doesn't wreck her. Maya's mortgage balance has dropped to about $28,000. The home, appreciating at 3.5% a year, is worth roughly $470,000. That's about $122,000 in home equity. Elena's original $65,000, growing at a historical market average of about 10%, is worth roughly $95,000 on its own. Add 4 years of monthly contributions and their growth, and her total portfolio is now worth roughly $112,000. They're close. Genuinely close. Maya has built substantial home equity. Elena has built a substantial investment portfolio. Maya can paint the living room whatever color she wants. Elena can move next month. Dana, the cousin, tries to flip a second condo the same year. The market cools right as she lists it. It sits unsold for 8 months, carrying costs eating steadily into the first flip's profit. Nobody brings it up at Thanksgiving. 2 years later, the market drops 22% in 5 months. It's on every channel. Elena watches her portfolio, on paper, lose almost a fifth of its value in a single quarter. Her co-worker, who'd been casually investing alongside her, panics and sells everything, moving it into a savings account paying almost nothing. He tells Elena she's still got time to get out before it gets worse. Elena doesn't sell. She doesn't check the account for 6 weeks, on purpose. She keeps the automatic transfer running exactly as scheduled, buying shares while they're cheaper than they were in January, whether she feels good about it or not. This is, unglamorously, the entire mechanism behind long-term investing, doing the boring thing on the worst possible day. Maya, for her part, doesn't experience the crash the same way at all. Her home's value dips slightly on paper too. Appraisals lag the market, but nobody's calling her asking if she wants to sell her living room at a discount. Her mortgage payment doesn't move. This is one of the quiet advantages of owning. Nobody can force you to realize a loss you never chose to take. By the end of year 6, the market has mostly recovered. Elena's total portfolio sits around $180,000. Her rent has crept to about $2,568. Maya's home is worth roughly $503,000, with a mortgage balance near $316,000, equity of about $107,000. Rates drop. Maya's lender sends her a letter offering to refinance her 6.75% loan down to 5.6%. She runs the numbers, $4,200 in refinancing costs. But her new principal and interest payment drops from $2,238 to about $1,980 a month. She calculates the break-even point, 19 months, decides she's staying at least that long, and does it. It's a smart move, and it's also a reminder of something the whole comparison tends to gloss over. Buying a home isn't one decision, it's a decade of small decisions after the big one. Refinance or don't, extra principal payment or don't, sell the car and buy a truck for the garage you always wanted or don't. Her new monthly housing cost, including taxes and insurance, settles around $2,610. Elena's rent, meanwhile, has reached about $2,723. For the first time in 8 years, Elena's monthly housing cost is actually higher than Maya's. By year 8, Maya's home is worth roughly $539,000, mortgage balance about $300,000, equity near $239,000. Elena's total portfolio sits around $250,000. Quick gut check before we keep going. If you had to guess right now, who do you think ends up ahead at year 20? The sister with the house or the sister with the portfolio? Say your guess in the comments before I tell you. I'll circle back to it. Before we go further, let's deal with the thing someone always brings up. Doesn't Maya get a tax break for the mortgage interest? Technically, yes. But the honest version of this is less exciting than people think. To benefit from the mortgage interest deduction, you have to itemize instead of taking the standard deduction, and after recent tax law changes raised the standard deduction significantly, most homeowners, including Maya, most years, don't come out ahead by itemizing at all. In the 2 years her interest payments were unusually high, right after the original purchase, itemizing saved her roughly $400 a year. In most other years, the standard deduction was simply the better deal, and the tax advantage of homeownership that gets repeated constantly online didn't apply to her at all. It's a real benefit for some people, in some tax brackets, in some years. It is not the guaranteed windfall it gets described as at Thanksgiving dinners everywhere. Maya is 39 now. Her home, compounding at that same 3.5%, is worth somewhere around $578,000. Her loan balance, helped along by the refinance, has fallen to roughly $283,000. Equity, about $295,000. Elena's portfolio has had 10 years to work. Her original $65,000 alone has grown to roughly $109,000. Layer in a decade of monthly contributions, smaller now since her rent has climbed to about $2,890 and her total sits near $340,000. For the first time, Elena's number is bigger. Not by a small margin either. And her money is liquid. She could wire half of it tomorrow if she wanted to. Maya cannot sell a bedroom. That same year, Elena finds out she's pregnant. She and her partner need a third bedroom, and the market for 3-bedroom rentals in their neighborhood is thin. She ends up paying $3,150 a month for a slightly bigger unit 2 streets over, a jump that has nothing to do with the standard 3% annual creep and everything to do with needing more space. Right now, with a baby arriving in 5 months. She briefly considers buying. She and Maya sit at Maya's kitchen table, the one in the house, and run the numbers together. A comparable 3-bedroom house nearby costs $495,000. Between the down payment she'd need and the disruption of moving with a newborn, Elena decides to wait. This is worth naming plainly. Renting isn't just cheaper or more expensive than buying in the abstract. It's also more responsive. Elena can upsize in 6 weeks. Maya, if she needed a third bedroom, would be looking at another $11,000 closing cost and a new interest rate environment. Elena's rent jump costs her about $427 extra a month that no longer goes into the index fund. Her portfolio growth slows, but doesn't stop. It's worth pausing here for a hypothetical, because the single biggest variable in this entire comparison isn't Maya's discipline or Elena's discipline. It's the mortgage rate Maya happened to lock in. If Maya had bought 2 years earlier, during a stretch when rates sat closer to 3.2%, her original principal and interest payment wouldn't have been $2,008 a month. It would have been closer to $1,002, a difference of more than $700 every single month for the life of the loan. Over 30 years, that single variable, timing, mostly luck, is worth more than almost anything either sister did on purpose. It's a useful reminder that renting versus buying is really renting versus buying at this rate, in this market, at this exact moment. The framework holds up across rate environments, but the specific numbers absolutely do not. Maya gets a job offer in another state. Better title, $22,000 more a year, a genuine leap. She spends 3 weeks agonizing over it. If she takes it, she has 2 options. Sell the house, which means a realtor's commission of roughly 6%. About $40,000 on a home now worth close to $664,000, plus the cost of buying again somewhere new. Or she can rent the house out and become a long-distance landlord, taking on a mortgage in one city and rent in another, hoping a tenant covers most of the difference, and praying nothing breaks while she's 800 miles away. She turns the offer down. Elena, meanwhile, gets a similar kind of opportunity 2 years earlier and takes it without much agonizing at all. She gives 60 days notice, packs a moving truck, and starts a new job in a new city with a new lease, her portfolio riding along with her, completely indifferent to which state it's registered in. This is the part of the comparison spreadsheets don't capture well. Mobility has a price, and it isn't always denominated in dollars. Sometimes it's denominated in offers you don't take. By year 14, Maya's home is worth roughly $664,000, mortgage balance around $245,000, equity near $409,000. Elena's portfolio, despite the rent jump from the baby chapter, sits around $480,000. Dana, still flipping houses on the side, tries a third project in year 14, this time buying a rental duplex instead of flipping it. She becomes a landlord. For a while it looks like the smartest move she's made. 2 rent checks a month, appreciation on top of it. Then one tenant stops paying, and Dana spends 4 months and $3,800 in legal fees on an eviction process before she can even start looking for a new tenant. She doesn't bring this up at Thanksgiving either. Maya and Elena start to notice a pattern. Dana only tells the first half of every story. Elena's portfolio crosses $500,000. For the first time, she seriously considers buying, not because renting has failed her, but because it's worked well enough that she can finally imagine writing a large check without emptying every account she owns. She looks at a $610,000 house 2 neighborhoods from Maya's. She runs the numbers with the same care Maya used 15 years earlier, A 20% down payment would mean pulling $122,000 out of the market, money that's been compounding at roughly 10% a year for over a decade. She'd be trading an asset that's been earning steadily for an asset with real, but slower and lumpier appreciation, plus new fixed costs, plus the loss of the flexibility that got her the job in Chapter 9 in the first place. She decides not to buy. Not because buying is wrong. It clearly worked out for her sister, but because at this specific point in her life, with a young kid and a job she might still want to relocate for, the trade doesn't make sense for her. This is the part of the video that isn't really about houses at all. The right answer keeps changing because the people keep changing. Maya's mortgage balance has fallen to about $165,000. Her home, now worth roughly $761,000, gives her equity of about $596,000. She's 2 years from paying off the loan entirely, and for the first time in 18 years, she does the math on what her monthly cost will look like with no mortgage payment at all. Just taxes, insurance, and maintenance, somewhere around $900 a month for a house she owns outright. Elena's rent, after 18 years of 3% annual creep on top of the baby-related jump, is now approaching $3,663 a month. Her portfolio sits around $720,000. Here's the part almost nobody accounts for. Maya's original $345,000 loan, at 6.75% before the refinance, was on pace to cost roughly $461,000 in interest alone over its full 30-year life. Not principal, not taxes, just the cost of borrowing the money. The refinance in year 8 cut that total meaningfully. But even so, by the time Maya's mortgage is fully paid off, she will have handed lenders somewhere in the neighborhood of $300,000 in interest across 2 loans. Add her original down payment, closing costs, PMI, a decade and a half of maintenance and repairs. The furnace, the foundation crack that turned out to be not so cosmetic in year 11, a roof replacement at year 16, and Maya's true all-in cost of this house, by the time it's paid off, lands somewhere around $830,000, for a property that will be worth somewhere between $780,000 and $830,000 by year 20. Roughly a wash, before you even count 20 years of shelter. Elena's all-in cost is simpler and uglier in a different way. By year 20, she will have handed roughly $660,000 in cumulative rent to landlords she's mostly never met, money that built her no equity anywhere, ever, adjusted upward by the baby-related jump in year 10. Both of them are paying a fortune for shelter. One of them is also holding an asset when the paying stops. The other is holding a portfolio that never asks her to replace a furnace. It's worth stopping to actually add up what Maya spent on the house itself, separate from the mortgage, because this is the number that almost never makes it into anyone's mental math when they compare renting to buying. Across 18 years, the furnace in year 4, $6,100. A foundation repair in year 11 that the original inspector's cosmetic, probably, turned out to undersell, $14,200. A roof replacement in year 16, $11,800. 2 water heaters, a dishwasher, a garage door opener, a stretch of fence after a storm, and the unglamorous ongoing cost of simply keeping a large object from decaying. Paint, gutters, a sump pump, termite treatment after a scare in year 9. All told, on top of her monthly maintenance budgeting, Maya spent just over $61,000 in surprise and semi-surprise repairs over 18 years that were not part of any mortgage statement. Elena, over those same 18 years, spent exactly $0 on any of it. When her dishwasher broke, she took a photo, sent it to her landlord, and made dinner reservations instead. This cuts both ways, and it's worth being honest about both directions. Maya's $61,000 in repairs is real money that produced no separate return. A new roof doesn't typically add $11,800 to a home's resale value. It just prevents the home from losing value it would otherwise lose. But it's also the cost of an asset that was simultaneously appreciating by tens of thousands of dollars a year. Elena avoided every repair bill and also never captured a single dollar of appreciation from the building she lived in. They're not really comparable line items so much as 2 completely different relationships to the same physical need, shelter. Here's the part the spreadsheet still can't show, even the honest version of it. Maya doesn't regret staying. The house has been a genuinely good home, and there's a maple tree in the backyard she planted the week she moved in that's now taller than the garage. But some nights she wonders what she gave up in Chapter 9, the job she turned down, the version of her life 2 states over that she'll never get to compare herself against. Elena, for her part, has moved 4 times in 18 years. She has an excellent portfolio and no single city she'd call home if a stranger asked her where she's from. Her daughter has lived in 3 different school districts. At Thanksgiving, Maya's kids know their aunt as the one who visits. Elena knows it too, and it costs her more than she says out loud. Neither of them ever brings this up directly. It shows up sideways instead. Maya gets quiet when Elena mentions a 5th possible move. Elena gets quiet when Maya talks about the tree. Dana, still recovering from the eviction, does not bring up real estate that year either. It happens on an ordinary Tuesday, not a holiday, which is maybe why it finally comes out honestly instead of politely. Elena is visiting for a long weekend, sitting on Maya's back porch, watching her niece climb the maple tree that's now taller than the garage. She says, quietly, that she sometimes wonders if she optimized her entire adult life around a number instead of around a place. Maya, surprising herself, admits the opposite worry, that she optimized her entire adult life around a place and quietly resents how much of her flexibility she traded to keep it. Neither of them apologizes for their choice. Neither of them regrets it exactly either. What they land on, after 20 minutes that neither of them plan to have, is something closer to the truth than either of their spreadsheets. They didn't pick a financial strategy 15 years ago so much as they picked a version of themselves, and the money followed. Dana's boat, parked in her driveway 2 streets over, doesn't come up at all. Maya is 49. Her home is worth somewhere between roughly $780,000 and $840,000. Her mortgage, paid off 18 months early thanks to a few extra principal payments in years 17 and 18, is now 0. Her equity is the full value of the house. Elena's portfolio, 20 years of compounding on a shrinking but real monthly contribution, has grown to approximately $890,000. Her rent, after 2 decades of increases and 1 major upsizing jump, is now nearly $3,900 a month, with no finish line in sight. On pure net worth, Elena is ahead by somewhere between $50,000 and $110,000, depending on where in that home value range you land. But the 2 piles of wealth have completely different textures. Maya's is a house she can walk through barefoot at midnight, paid off, hers, generating no monthly costs beyond taxes and upkeep. Elena's is a number on an app, fully liquid, movable to any city on 60 days' notice, still generating a $3,900 monthly bill for the roof over her head, forever, unless she eventually buys something herself. Neither number is the correct one. They're just answers to 2 different questions. Here's the wrinkle that usually gets left out of these comparisons entirely. Maya's $780,000 to $840,000 house isn't spendable unless she sells it or borrows against it, and both of those come with costs and consequences of their own. If she sells, she pays a realtor's commission, transfer taxes, and closing costs on the sale. Easily $50,000 to $60,000 gone before she sees a dollar. If she borrows against it with a home equity line, she's back to paying interest again, on a house she already thought she was done paying for. Elena's $80,000-$90,000, by contrast, can become cash with a few clicks and a short settlement period, taxed at capital gains rates that, depending on her income, might be lower than what she'd expect. Net worth on paper and net worth you can actually use are not always the same number, and the gap between them tends to matter most exactly when you need money the most. A job loss, a medical bill, an emergency that doesn't wait for a house to sell. Buying tends to win when you stay long enough for the upfront costs to get absorbed. Most people need 7 to 10 years minimum before the math even starts to favor them, and Maya needed closer to 15 before she was unambiguously ahead in equity terms alone. It also depends heavily on the price-to-rent ratio in your specific market. Take the home price, divide by a year of comparable rent. Maya's original $410,000 house divided by $25,800 a year in comparable rent gives a ratio of about 15.9, moderate. As a rough rule of thumb, above roughly 20, renting usually pulls ahead. Below 15, buying usually does. Between the two, it comes down to the details: your mortgage rate, your local property tax rate, how long you'll actually stay, and what you'd realistically do with the money if you didn't buy. Renting wins when you genuinely invest the gap every month, without fail, for years, including the months the market drops 22%, and every financial headline sounds like the end of something. That discipline is the entire engine. Remove it, and renting is just spending with extra steps and a landlord. Maya traded flexibility for a fixed cost, forced savings, and a place that's unmistakably hers. Elena traded permanence for liquidity, mobility, and more money working in the market. Neither twain made the wrong call. They just answered a different question than the one their cousin thought she was answering with a boat. There's also a version of this decision that isn't binary at all. And it's worth naming before we close. Plenty of people buy a home and keep investing anyway, on a smaller scale, once the initial down payment shock wears off. Plenty of renters eventually buy, once their life settles into something that looks less like a question mark. Maya and Elena make a clean, deliberate comparison precisely because they never changed course. But almost nobody actually lives that cleanly. Most people's real financial lives are messier, with a rental in their 20s, a starter home in their 30s, maybe a rental again after a divorce or a job change, or a kid who leaves for college. The math in this video still applies to every stretch of that messier timeline. It just applies in smaller, overlapping pieces instead of one continuous 20-year experiment. If you're weighing this decision for yourself right now, the two numbers that actually matter are how long you're realistically staying and whether you'd actually invest the difference if you rented every single month, including the bad ones. Tell me both in the comments and I'll tell you which way the math is leaning for you. And if this kind of breakdown is useful, subscribing helps more than you'd think. It's how these videos find the people who actually need them. Somewhere right now, someone is standing in a parking lot holding paint swatches for a house they don't own yet, doing the math in their head, certain there's a clean right answer. There isn't. There's just the answer that fits how long you're staying and whether you'll actually follow through on the plan you're making tonight.